You wake up, grab a coffee, and log into work. The markets are open. Salaries land in bank accounts. Politicians speak in measured, confident tones. Everything looks entirely normal. But beneath the surface, the foundation of the global economy has already fractured. What you are hearing right now are the creaking sounds of a financial bridge failing. In early 2026, the yield on UK 10-year gilts, the baseline interest rate the government pays to borrow money for a decade, crossed the 5% threshold for the first time since 2008. This chart shows how these fractures are appearing everywhere at once. While bond yields spike upward, gold has surged past $4,500 an ounce. At the exact same time, trillion-dollar private credit funds, the shadow banking system that lends directly to private companies, are locking their investors out, refusing to give them their money back. The physical world is exacerbating this financial strain. Following the sudden destruction of the world's largest liquefied natural gas, or LNG, facility in Qatar, nearly 20% of the global LNG supply is offline. Repairs will take years, not weeks. The isolated shocks to bonds, gold, and gas production share a single structural cause. A massive, load-bearing economic system has reached its physical limit and is beginning to bend under the weight. To understand how the structure got so heavy, we have to look at the post-World War II financial architecture. The global system was rebuilt on a single core assumption. Government bonds, particularly U.S. Treasuries, were the safest asset you could own. They became the risk-free bedrock that pension funds, insurance companies, and entire currencies relied upon. That assumption held until 1971, when Richard Nixon severed the U.S. dollar from the gold standard. By removing the physical constraint of gold, governments gained the ability to create new money without limit. This created what economists call the Cantillon effect. When a central bank prints new money, it doesn't distribute evenly. It flows first to the largest financial institutions and governments. By the time that money filters down to the wages of ordinary workers, the early recipients have already used it to buy assets, driving up the prices of housing and stocks. It is a continuous upward transfer of wealth. This schematic of a river valley represents the policy response since the year 2000 as a massive dam-building project. Every time the economy stumbled, central banks built a new wall of debt to hold back the floodwaters, lowering interest rates and printing more money. We saw it after the 2008 financial crisis. We saw an even larger dam built during the multi-trillion-dollar COVID response in 2020, and we saw another during the tariff panics of 2025. Each intervention bought a few years of stability, but each required a larger, more fragile dam built further upstream, allowing a highly leveraged financial ecosystem to grow directly in the flood zone. Now, the mechanism is trapped. The exact policy tool that saved the system for decades, printing money to buy bonds, requires low inflation to work. With inflation running hot, printing more money will only accelerate rising prices. The rescue tool has become a demolition tool. This financial fragility is colliding with a physical reality. The conflict in Iran has effectively closed the Strait of Hormuz to commercial tanker traffic. 20% of the world's oil and liquefied natural gas flows through a waterway just 33 kilometers wide, and right now that energy is trapped. The United States Navy decommissioned most of its specialized minesweepers years ago. The remaining vessels in the region were relocated for logistical stops just days before the conflict escalated, leaving the maritime security choke point wide open and uncleared. The financial strain is worsened by a sudden shift in the labor market. Artificial intelligence is now autonomously completing tasks that previously required highly paid professionals. As corporations replace these roles with software, the income tax revenue that sustains government debt payments begins to evaporate. The tax base is shrinking at the exact moment interest bills are climbing. And AI requires power, massive amounts of it. The global electricity demand for AI data centers is expected to double, forcing these facilities to compete directly for resources on a global power grid already crippled by the Middle East energy supply disruptions. Because these physical energy shortages drive the cost of everything up, inflation is running structurally hot. Central banks are entirely paralyzed. If they print money to bail out the struggling economy, they risk triggering a hyperinflationary spiral. The trillion-dollar private credit funds face a structural dilemma. Software companies hit by AI-driven price drops can no longer service their debt. This translates directly into a solvency crisis for the funds that lent to them, as the underlying assets no longer generate the cash required to repay investors. We are at a mathematical breaking point. The massive deflationary force of AI automation is colliding head-on with the hyperinflationary force of broken energy supply chains. Policymakers are trapped between these two extremes, with no available exits. Systemic failure rarely looks like a sudden explosion. Most people experience it as a grinding, multi-year erosion. Your savings buy less each year. Your real wages fall behind the cost of living. The pension you thought was secure is invested in government bonds that are actively losing value. When governments run out of cheap funding, the historical pattern is incredibly consistent. They turn to their citizens' wealth. First, through taxation, then through financial repression, and finally by aggressively trapping capital within their borders. We are seeing this sequence play out in the UK right now. Capital gains taxes are climbing. HMRC, the UK's tax authority, is actively expanding its data-gathering powers over private financial accounts, and the state is forcing the consolidation of private savings into pension megafunds, creating vehicles to absorb government debt. Governments eventually resort to capital controls and exit taxes to prevent money from leaving the country. History shows these measures arrive without warning, often over a single weekend, to ensure no one can react before the locks are in place. Navigating a transition of this scale requires acting on a set of rules defined before the panic starts. By the time the evidence is undeniable to everyone, the window for a calculated response has already closed. Navigating this requires a barbell strategy. On one end, you build resilience by developing non-automatable skills. You learn to direct AI rather than compete against it, and you actively invest time in rebuilding local, physical community relationships that do not depend on digital networks. On the other end of the barbell, you move wealth out of fragile government-issued currency. You secure your savings in hard, portable assets, like gold or Bitcoin, that feature a fixed supply and cannot be easily printed or physically seized by a desperate state. The cars are still driving, the band is still playing, but the bridge is carrying too much weight, and the fault line is highly active. The decision isn't whether the global economic system is going to bend. The math is already doing that work. The only question left is whether you will step off the bridge while you still have the option to do so.